All right, so welcome to StockAbility. My name is Dan Bustamante. In this short video, I'm going to be discussing the advisor myth. This is probably part one in a 2 to 3 part video series where I'm going to discuss some of the conflicts of interest, not only with financial advisors, but the world of Wall Street. So quick disclaimer, none of the information contained in this presentation is investment advice. This is for educational purposes only. There is risk of trading securities in the market. So again, as you go through this, please be smart. Please be logical as you go through our videos. So again, kind of our foundation, if you haven't learned already at StockAbility, is that it's your money, your move. That kind of leads into this concept that nobody's going to care about your money more than you. That's true in anything else. We all know that. If you're going to do something on your own, typically what's the saying is, if you want something done right, do it yourself. So what I'm going to discuss in this mini lesson is the financial advisor conflict, the conflicts of interest that are present in that industry, and not only that industry, as itself, but Wall Street as a whole. Then I'm going to dive into this kind of a typical week of a trader and investor, because there's kind of this myth and misconception that this is something that you have to do 5, 6, 10 hours a day, that it's go, go, go. It's not. At least in my opinion, from speaking with people, friends that want to get into this, I'm going to try to dispel a lot of these rumors, not only with the financial advisor concept, but in the kind of trader investor, your typical week. So let me talk about this conflict of interest. So this is from an industry insider. I have 14 plus years in the financial services industry and working on Wall Street. Again, I never worked in New York. So when people say, hey, look, I work on Wall Street, it's kind of a marketing term, right? So let's kind of start there. I started my career as a proprietary futures trader. I was an options trader for a family office. I worked at a Forex broker dealer. I worked at Charles Schwab when I was 20. And most recently, I was a portfolio manager and a long short hedge fund. So I've run the gamut of different positions in the financial industry. I also know people that work as financial advisors. If you're watching this video as a financial advisor, I'm sorry if you get offended for some of the things I'm going to say. So is there a conflict of interest with financial advisors? Well, that's something for you to decide at the end of this mini lesson. I'll give you my insights and my feelings, and I'm going to present some facts and show you how that business model works, that you make that decision. Plus, I'm going to discuss a typical trading week and show you that what this really involves. Now, again, what I discovered coming from the institutional side into the retail side and seeing YouTube and different forums, which a lot of you might be aware of, there's a lot of bad information. There's just none of the people have worked institutionally, worked on trade desks, worked at funds, but they're giving you information as if they did, as if it even matters, by the way, right? So I want to dispel some of that. Is that what's a typical week, trading and investing in markets? So let me start here. Let me start with the financial advisor business model. There's typically 3 lines that are run. It's a commission model, an hourly fee model, and then the assets under management model. Now, some of these I agree with, some of them I don't. I'll kind of talk to you about it here. So one of the biggest models in financial advisory is pushing products, is where they get a fee up front. So some mutual funds, again, I've never once in my life invested in a mutual fund. I would never advise anybody to, friends and family, I don't have them in mutual funds when they ask questions. Additionally, right, they're called structured products. Either front load or, there's an investment fee taken off the top that goes directly to the financial advisor's pocket. You have to be cautious of this because, again, whether or not you're making money, they get a fee off the top. Now, again, that's typically through annuities. Now, am I against annuities? Absolutely not. They serve really good purposes depending on where you are in your life, financially, etc. There's some good purposes to it. Now, obviously, you've got to be careful because just like there's good and bad financial advisors or good and bad attorneys or CPAs, it's the same with every industry. You have good and bad. So you have to be really, really careful of the fees that come with the products they push. You have to ask and say, look, are you pushing this at me because you're getting a fee or because it's in my best interest? Right? The second thing is hourly fees. Now, I actually don't disagree with this. I actually agree with this model and some of the services it provided. Again, I've used this before myself, whether it's been financial planning things that I've gone through, consultation on some retirement stuff I've done, or different matters, right? Whether it's, like trust stuff, business taxes, personal taxes, planning, like, your retirement, your estate. There's really good services provided by financial advisors there. Now, typically it's done on an hourly basis. Again, I've done it myself, but again, they don't manage my money. Would I give my money to manage? Of course not. There's no way that would ever happen. Now, the third model, and typically the most prevalent model in this business, is the assets under management fee. This is where primarily they make most of the money. Now, let me start and stop here. I'm not against making money. I think it's everybody's right in this country to make money. I'm a capitalist at heart. However, right, there's a kind of a conflict of interest with this that I want to discuss. Typically, there's a 1% or less management. I've seen it as high as 2%, which I think is purely ridiculous. But the business model is this. The more assets the financial advisor has, the more money they're making. Now, the difference is this. Whether or not you make money, they still get a percent of your assets as a fee. The world I came from, again, our fund wasn't like this, but I'll give you the standard model. You got 2% of the assets that we managed that typically went to cover your overhead, expenses, like, soft dollar expenses, small salaries, office, especially legal fees, especially accounting fees, audits. That's where that money went to. Then there was 20% of your profits. Now, this is where it's kind of the eat what you kill model in the hedge fund industry. So if we didn't make our clients money, we didn't get the 20%. So we were incentivized to work hard, to be focused, to come up with good ideas, to produce a return so that we could extract our 20% fee. In the financial advisor industry, there is no performance fee. It's purely a 1% or lower. Typically, again, it's up to, I've seen 2% fee that people are getting charged. Regardless of whether or not you make money, they make money. I have a problem with that as a conflict of interest. They're not incentivized to do right by you because, again, they get paid regardless whether or not you make money. This brings me back to the entire kind of concept of our back office. When myself, Vince, and Sam, and the rest of the team put this together is, look, nobody's going to care about your money more than you. You know it, I know it. Now, the issue is people are scared to manage their own money because they don't know where to start. Obviously, that's where we come in. And this is where I want to transition this conversation into what does a typical week look like as a trader investor? Because again, it may not be what you think it is. So let me kind of give you a shadow kind of insight to what that is. So there's kind of a typical week. Now, it varies for different people. If you're like a true professional and this is like your job, your career, it's not 4 hours a week. But most of us don't have to be professionals. If you're like my father or friends that do this, you don't need to do this every day. You can get this done in 4 hours a week. So for myself, I'm more active, right? This is one of my primary businesses is trading markets. So I actively trade futures, I actively trade options. So let me discuss a typical week. We discussed this concept called weekly preparation of how you prepare your week in our one of our classes called Foundational Ability. So we give you an outline how to run a model to say you do this, this, and this to prepare your investing week. So a typical week kind of looks like this. And let me just go step by step through this. I trade futures personally. So my week will typically start Sunday afternoon with a brief market analysis. I look and see what's going on. I might look at a trade. I might not look at a trade, but I look at the market overview. Then I decide to place a trade, then do my analysis on 5 stocks. So I typically follow 5 to 10 stocks. That's it. I may make one trade a week. I might make 10. It just depends on the market. Now, typically Monday to Wednesdays are only the usually days I put trades on or I take trades off. I rarely ever trade Fridays, sometimes trade on Thursdays. My trading day, 90% of the time is done by 11 a.m. Sometimes at night, I might trade the pound or yen. Very rarely, right? But again, you have to understand, I'm an active trader. I come from the world of being active in institutional markets. You don't have to be this. This doesn't have to be you. You can be this. I wake up, I look to see, let's say I have I'm long Apple. I wake up the next day, I say, is it reached a price target? Am I going to sell that position? Am I taking a loss? Am I taking a stop out? Or am I adding new positions? It's a very simplified, direct approach versus this concept of what you might see in the world of the retail side of education of it's day trading. You've got to be active. It's not anything like that. And I want to dispel that as you're watching our videos. So for me, I'm in the capital growth phase. I'm not in retirement phase. I'm relatively young, at least I think I am. So I'm at the phase in my life where I'm growing capital. So I'm not looking at, long-term buy and hold. I'm looking at short-term investing to grow capital. That being said, the markets can be what you want them to be. We have different programs here that range from wealth programs to income with Sam to options trading. There's different concepts you can apply because, again, it's not one size fits all. For many, slow growth is where you want to start, right? So you can choose different programs, and if you're confused, I'll give you some insights on what to do to figure out which program is best for you. So that's kind of a short insight to the trading week. What are the next steps I would advise you to do as you want to learn more about this? Number one, attend a webinar. The webinars are amazing. You get a lot of free information. You can ask questions, and you can really see what we're about. Number two, you can schedule a call. We have a great team, Rosie, Susie here. They can discuss things with you and talk to you about our programs. Number three, we have a quiz. It's awesome. You can go to right on the website. If you have trouble finding it, call us. Schedule a call. Susie or Rosie will walk you through it. Take the quiz. What it'll do is it'll put together what, in our opinion, might be the best route for you and your personal goals. So that being said, this is a short video into part one of this little mini series. Thanks for watching this video. Hopefully we'll see you in one of our webinars, and we'll see you in the next video.